Hello and welcome to the Property Pod and our first episode for 2026. Here's to a great year ahead for South Africa and our listeners and readers, who we value tremendously. And of course, a great year, hopefully, for the markets and the rand, which seems to be doing pretty well at the moment. So there is some optimism despite all the scariness in the world, particularly in the Americas. But we're not going to delve into that topic. This is the country's premier weekly property investor podcast. And on this Moneyweb show, we gain insider insights from leading CEOs, analysts, developers and entrepreneurs in South Africa's dynamic real estate sector. On this latest episode, we have Ahmed Mutara, an equity analyst at StanLib, and considering the time of the year, we wanted a wrap of the sector's 2025 performance and what we can expect from SA REITs in 2026. Will the rally continue? I suppose that's the big question. Welcome back to the Property Pod, Ahmed. It's been a while.
Thanks for having me, Suren. Much appreciated. And hello to all your listeners.
The last time we spoke, I can't believe it's that long, was way back in July 2022. That's on this podcast. We have had some comments from you on some listed property results and their performances during the last year. But things were very different back in July 2022. The listed property sector, when I looked at that pod, was struggling and was down at the time. That was in mid-2022. But last year, 2025, was a big turnaround year with the sector's performance being stellar, ending off quite strongly for the year. Obviously, that was the case for the JSE overall. But Ahmed, can you give us some insights on the sector's performance, how it ended off? I don't know if we still look at the SAPI, but there is the SAPI index and the LP.
Yeah, no, thanks, Surendra. Look, it was an incredible year for property. I look at both of the indexes. Both the SAPI and the ALP delivered around 31% over the course of 2025. That's a total return number. On a capital return basis, around 24% of it was capital, with around 7% in terms of an income return. It was a very strong year for the sector. You can't deny that. It also, just to put it in context, was very much a tale of two halves. When you think about it, by mid-2025, by the end of June, the property sector was only up around 6% on a total return basis. In the second half of the year, it delivered around 23%. No surprise, it was the SA 10-year bond yield that was the key thing, which in the second half of the year strengthened down to 8.2% at the end of December 25. In the first half of the year, it only moved 40 basis points. So it really was a story of the macro, of the positivity around the country, of how the property sector was recovering, and all of that came together for the sector to deliver the type of return that is above the typical return you would get from the property sector.
And if you compare it to equities, that performed quite strongly, but I suppose cash didn't.
Yeah, I mean, I think cash is the poor cousin right now compared to many other sectors. Obviously, you got your gold, your platinum stocks that have doubled or tripled in some instances. You've got Naspers that has done well. The banking shares have done well. So many equity sectors in South Africa have performed incredibly well. Again, on the back of probably what is a strengthening SA 10-year bond yield, a very strong South African rand versus the dollar, and a lot of people looking at the market and saying South Africa looks like a good place to be right now.
Well, the CEOs of SA REITs have been talking for a few years now about, the economy needing to grow. We didn't exactly have great growth last year, and we'll talk about growth expectations going forward. But clearly, you didn't mention interest rates in that wrap. Clearly, that was a big factor, lower rates, that is. Do you agree? What were the other factors in that stellar performance of the listed property sector last year?
I think you're quite correct. I think we had 100 basis points worth of cuts come through in 2025 in South Africa. There was also a multitude of other supporting factors that became evident. One is obviously that operational recovery underway that the CEOs at the REITs have been talking about for a long time. We've been saying ourselves for many years that the sector has now got a sustainable income base. I think if you just go back in history a little bit, you 2018, you had resilient viceroy type of concerns. You had the COVID dynamic. The sector's been under pressure for many years. Income has rebased, the balance sheets are better. And what's most important, I think, is that the asset values of the physical properties have started to stabilize very much. I think that's a big thing. I think investors were looking for that as the starting point to say, you know what, things are starting to come through because if asset values are stabilizing and interest rates are lower, that means income must be coming through to some extent. And that, I think, was quite important. Companies are starting to surprise to the upside when they're reporting real results. And for me, the big thing is if I look back to the start of 2024, I was looking for about 2% growth in dividend income for 2025. Over the course of the year, I've had to revise my numbers up. And now we're looking for near 6% growth in dividends for 2026. So a couple of these factors came through. You've also got renewables, the ability to pass on the Eskom price increases to the tenants and capture that as a landlord. That's a big thing. Very high IRRs or return on investments that are achievable from those solar installations. And if there's one other thing that I think maybe overrides everything, it's sentiment. And, I think it's taken, we've been saying for a while, but we're property specialists. It's taken a while for the conviction and belief in the property sector to come through, particularly for the general equity guys. Their weighting in properties probably been too low over the past few years. They understand it's a high beta play on the SA bond sector. That meaning if the SA bonds do 5%, property will tend to outperform that. And then the flexible funds, the guys who, as you were saying, cash is maybe the poor cousin, as I was saying. The flexible funds who look at property, bonds, and money markets are seeing a very strong SA 10-year bond. And knowing property is a high beta play on that, they're looking at it as somewhere where they can invest. But the other point you made, around all these equity sectors doing well, with the lower interest rates we're now seeing in SA, the lower SA 10-year bond yield, the weighted average cost of capital assumptions that guys have been making for the whole market have had to come down to some extent. And that's really driven, I think, to a large extent, a lot of these re-ratings we've seen in property and other sectors.
Was it a case of it being a big re-rating year for the sector? Because that re-rating has been talked about for a few years now, but the discounts have narrowed quite a bit.
They have, the sector is really now at around 0.95 price to book. You could almost call it a 1 times price to book multiple. Some of the stocks are trading at price to book multiples they haven't traded at before, and the dividend yields that we haven't seen for a very long time, and in terms of how much they've compressed. The re-rating, look, the hardest thing in the market, I think, is to call the point at the top and the point at the bottom. But you can kind of get a sense when you're getting to either side of the equation. For a few years, we've kind of believed a re-rating was due for the sector. It just happened to be in 2025 that a lot of things like the lower interest rates, the SA 10-year bond yield, the currency all came together and provided, I think, that impetus with the operational recovery for the sector to deliver what it did.
Now, some crystal ball gazing here, it's difficult to say considering what's happening globally, geopolitically, and I'm not going to ask you about those questions. But what are your expectations for 2026? Is there some room for the rally to continue?
It's a fascinating question, Suren, and one which I wrestle with a lot. Normally when you have a near 40% performance from a sector in 1 year, it's not easily for it to be replicated in the next year. You need the earnings to come through at quite a rate after that type of re-rating to justify a strong return as well for the following year. Effectively, we've had that positive re-rating in 2025. In a normal year, as many investors know, property will tend to deliver a 12 to 15% total return. That's assuming no re-rating or de-rating. Every analyst, I think, out there has a base case of 12 to 15% if the sector doesn't re-rate or de-rate. And that's really starting with an income yield of 8% and 6% income growth. It's not rocket science. You put those two numbers together, you end up in the mid-teens in terms of total return. We know that the operational recovery in the sector is very much underway, but I think you probably alluding it to a bit, but you're right. You can't expect another 40% as a base case in 2026. I think the expectation needs to be toned down a bit. Obviously, the bond yield has been a strong driver of where the sector has ended up right now. If the SA 10-year bond yield continues to strengthen from here, and with the lower inflation target that we have in place now, well, then the property sector could probably do a little bit more. But, with the sector already at 1x price to book nearly, if you end expecting another 40% rally, you're expecting the sector to start approaching 1.3, 1.5 price to book, which is very heady levels for the sector to get to.
Well, we had those heady levels back in 10 years ago, 2016, or just before that, when everybody was talking SA REITs and there were multiple listings. Just turning to a little bit backward focus here, what were the top performers last year, if you can highlight maybe the top 5 from SA REITs total returns? Because my colleague Simon Brown interviewed good old Keelan, who used to be at Stanlib a few years back, and when I looked at the figures, some of the big players were much higher than even the sector's performance at over 40%.
Yeah, I mean, look, I think, as I said, the sector has delivered around the 30, what did I say, around the 31, 32% type of levels. If you're looking at the bigger stocks like Vukile over 2025 delivered a total return of 48%. Growth Point, a big heavyweight diversified stock, delivered 48% as well. Resilient also 48%. These are the more liquid ones. Redefine did 44%. And 2 of the smaller companies, Fairvest B, did 63% last year. I mean, wow. This has really come through, not in terms of earnings growth of 63%, but just a very strong re-rating dynamic and earnings growth now guiding, I think, close to the high single digits for the next year. So the stocks have done incredibly well. It was, you could call it, the year of the re-rating for many of them.
So are we going to look at most, I know you were a bit technical there with your talk about 1 times 0.3, I think it was. Is that a case of the sector looking at possibly trading at a premium this year?
So I think if I break it down into 2 dynamics, one is going to be the fact of it's an income yield sector. It's a quasi-bond in terms of the way people perceive it, a quasi-bond, quasi-equity. And the income yield is the primary determiner of how they value the sector. Then obviously when the sector gets to a very low dividend yield, it starts trading above 1 times price to book. People start to think that, it's starting to get a little bit heady. Call it a cap when stocks start approaching 1.2, 1.3 times book value. So the sector now is almost at 1 times book value in terms of where it's trading. I would struggle to see it go way above that level, unless obviously the bond yield continues to strengthen materially from right here.
And putting you on the spot here, do you have any stock picks or rather stocks to watch in 2026?
Look, I mean, if you put it in context, I'm just talking amongst some of the bigger names. You've had Growth Point, Redefine, delivering around 40 to 50% total returns, when the sector itself only did 31, 32% over the course of the year. The one stock I think worth looking at is maybe something like Nepi Rockcastle. It's representing good value with a decent starting yield of 8%, income growth of around 5%. It also underperformed the sector over the course of 2025. So one of the 3 big heavyweights that didn't perform as well as people might have expected it to. And then you got stocks like Burstone. I think before it used to be called Investec Property Fund. It's offering almost an 11% starting dividend yield, near the highest in the sector. The thing about the sector, which, when you say what stocks I would watch in 2026 is, it's very niche in terms of, you can buy Western Cape exposure with Spear, you can buy Spain with Vukile, you can buy community shopping centers with Tupula. They're all strong stocks with their own specific underpins, and I think you can craft quite an interesting portfolio with very good diversification benefits in 2025 as an investor. Sorry, in 2026 as an investor.
No worries. And what about Hyprop? It has also done well, but you look at the growth and you compare the growth of like a Vukile. Vukile has overtaken Hyprop and features amongst the top 5. They haven't. Hyprop hasn't been as aggressive in terms of growth as the likes of Vukile and others.
Yeah, I mean, Hyprop delivered a good number, delivered 32% total return over 2025. The sector did 31%, and Vukile, as I said, did 48%. I think Vukile is really benefiting from that Spain exposure they have, the way those assets are performing. And I think Spain is the strongest GDP growth market in the European Union. So they've really got good access to good assets, and they're delivering on that right now. And the SA portfolio also is performing incredibly well in terms of trading densities and turnover growth. So it's really becoming very much an asset-specific thing in terms of the way these stocks are performing. I think Hyprop, with its regional shopping center portfolio, has also done very well, but it'll struggle to keep up with the Vukile, I'd argue, in terms of its growth per annum over the next couple of years.
Just to conclude, Ahmed, in terms of interest rates, obviously the inflation, the target being revised down now, so it's almost locked in lower interest rates. Let's hope the economy picks up over 1%. Interest rate and other positive trends for the sector ahead, or potential headwinds?
I think the expectation now is we've had 100 basis points of cuts in 2025. I think the consensus expectation is for 50 basis points to come through in 2026. I think the other dynamics, that are positive for the sector, you're seeing the asset value stabilize of the underlying properties. You're seeing this transition to renewables, the solar dynamic in terms of the way that's supporting the property sector's operational performance. It's interesting you talk of trends, because when you look at the broader reported retail sales numbers, to retail the consumption numbers, etc., it doesn't paint a very positive picture for the property market or for the retailers and the property sector. But when you talk to the retail property CEOs, at the landlords, that is, at some of these property companies, they say it's very asset specific. The assets that they hold are tending to perform a lot better than what the overall trend is showing. So I think what you're going to see as the trend in 2026 for the property sector is sustainable earnings, higher conviction in that earnings come through, asset value stabilizing, but lower overall returns than what we saw happen in 2025.
Ahmed, we'll have to leave it there, and we'll have to catch up at another time. It's been a great conversation. That was Ahmed Mutara, a market analyst at Stanlib.